Magnus Carlsen, the man who built an $82 million digital empire, yet mathematically cannot afford to stop playing a board game. He pays more in taxes than he earns in cash. In one fiscal year, his effective tax rate hit 127.45%. That is not a misread. For every dollar of realized income, the Norwegian state demanded $1.27. The question is not how a chess grandmaster gets rich. The question is why, with a $25 million net worth, he is structurally forced to keep grinding on the competitive circuit. The answer lies in a tax code that treats appreciating assets as immediate income, and in corporate contracts that legally prevent him from promoting his own products. The standard chess professional operates a linear, fragile income model. Tournament wins, coaching fees, streaming revenue. The moment the competitor stops competing, the cash stops flowing. No underlying infrastructure, no scalable software assets. Pure labor monetization. Magnus Carlsen rejected this model entirely. His wealth engine is bifurcated. Approximately 30% comes from active labor. Tournament prize money exceeding $1.2 million in a peak calendar year, plus roughly $2 million annually from corporate sponsors like Puma, MasterCard, and Unibet. The remaining 70% is something else entirely. Passive equity realization, corporate consolidation, venture incubation. He channels his brand equity through a domestic holding company, Magnus Chess AS, into digital platforms that can be scaled and sold. The active labor faces severe tax drag in Norway, 45 to 60%, when you account for federal taxes, municipal taxes, and management overhead. The corporate income routes through the holding entity experience a slightly lower drag, 30 to 50%, but the blended reality is brutal. A 50% deduction across all revenue streams is a defensible baseline for calculating his actual free cash flow. The industry standard shifted permanently when Carlsen executed the corporate roll-up. Instead of simply streaming games on third-party platforms for fractional advertising revenue, he founded Play Magnus AS, an ecosystem that systematically acquired Chessable, Chess24, Aim Chess, New in Chess, and Everyman Chess. He bundled these assets into the Play Magnus Group, took the entity public on the Oslo Stock Exchange, and then sold the entire conglomerate to the dominant competitor in the space for $82.9 million. 13 Norwegian krone per share, a 44.42% premium over the volume-weighted average price. This was not a tournament victory. This was enterprise value realization, generational wealth, secured through corporate acquisition, not board performance. But here is where the architecture cracks. After selling his digital empire, Carlsen co-founded a new application, Take, backed by $9 million in seed venture capital from firms including Skyfall Ventures and Kotu Management. The problem? His previous buyout agreement included a restrictive, long-term ambassador contract with the acquiring monopoly. When Take expanded into the play and learn sector, the monopoly retaliated. They terminated broadcasting rights for specific premium tournaments. They contractually barred Carlsen from publicly promoting his own multi-million-dollar venture, a founder who cannot market the product he capitalized. This is the Retention Valley paradox, the perfect corporate exit that became a legal cage. To understand the actual financial pressure, you need the real numbers. Carlsen's estimated net worth stands at $25 million, but that figure splits into two very different categories: liquid assets, cash, public equities, remaining capital from the buyout, total approximately $10 million. Illiquid assets, Scandinavian real estate, private equity, venture capital positions account for $15 million. The real estate is concentrated in Oslo, a waterfront condominium in the Tjuvholmen complex, acquired for 21 million Norwegian krone, a primary residential estate in the Holmenkollen Hills, purchased for 19.5 million krone. The venture capital positions are locked in companies like Sport AI, a machine learning platform for sports technique analysis, and Toka Football, a tech-enabled soccer entertainment franchise. These are early-stage, highly illiquid holdings. They cannot be converted to cash without triggering massive secondary market discounts. So the liquidity ratio is 40%. That sounds adequate, but the liquidity quality score tells a darker story. Liquid assets get a weight of 1.0. Real estate, depending on the property type, gets a weight between 0.3 and 0.5. Private equity and venture capital get a weight of 0.1. When you run the math, the quality score lands at 50.6 out of 100, a portfolio heavily skewed toward high-risk, low-liquidity startup equity and geographically concentrated real property. This inherently destabilizes his ability to pivot rapidly in volatile macroeconomic environments. Now, the auditor's challenge. Here are the numbers you need. The stated liquid assets are $10 million. The effective tax rate in the peak fiscal year was 127.45%. The estimated annual blended revenue before tax, combining active and passive streams, is approximately $3.5 million, with a 50% blended deduction, producing roughly $1.75 million in net cash flow. But the wealth tax applies to total global assets, not income, and his total net worth is $25 million, with $15 million of that locked in assets weighted at near zero liquidity. Based on these figures, estimate Magnus Carlsen's true deployable free cash flow after the sovereign wealth tax obligation is satisfied. Write your estimate in the comments. We will reveal the structural reality on the other side. The core mechanism driving this entire financial architecture is capital leakage through sovereign wealth taxation. Norway imposes a national wealth tax that targets total global net assets, regardless of their liquidity or their ability to generate positive cash flow. This is the mechanical engine of the paradox. The state assesses the paper value of real estate holdings and private corporate equity. If those assets appreciate, the tax liability compounds, even though no cash has been realized to pay the bill. The evidence is absolute. Forensic analysis of Norwegian tax records confirms that in the peak fiscal year, Carlsen paid an effective tax rate of 127.45% on his realized taxable income. This mathematical impossibility, paying significantly more in liquid taxes than was actually earned in liquid cash, is the direct result of the wealth tax assessing the astronomical paper value of his corporate equity and property holdings. This structural mandate creates an unrelenting paradigm. Simply owning a successful, appreciating business generates a massive annual debt to the government. The wealth tax transforms appreciating assets into compounding liabilities. And because the venture capital positions are locked behind severe illiquidity premiums, they cannot be sold to cover these obligations without accepting fire sale discounts. The result is forced operating leverage. Carlsen is structurally prohibited from resting on his accumulated assets. He is mathematically forced to continually compete on the global circuit, secure high-yield international sponsorships, and aggressively launch new digital products, solely to generate the liquid cash required to service the sovereign tax liability on his own illiquid wealth. This is the mid-roll cliffhanger, the intrinsic vulnerability. Carlsen serves as the singular marketing engine and primary brand validator for his entire portfolio of early-stage companies. His name is the customer acquisition funnel. Simultaneously, the Norwegian wealth tax aggressively targets the paper valuations of these exact startup investments. If one of his venture holdings achieves a unicorn valuation on paper through subsequent funding rounds, his personal liquid tax liability will explode exponentially. Without the immediate ability to freely promote, scale, and quickly liquidate these assets, due to contractual ambassador lockups and market illiquidity, he faces a severe liquidity bottleneck. This structural flaw could mathematically force the fire sale of premium equity assets simply to satisfy the state revenue authority's demand for liquid cash. The appreciating asset becomes the liability. The successful company becomes the threat. The final ledger resolves the central mystery. Magnus Carlsen's total estimated net worth reconciles to $25 million, $10 million in liquid capital, $15 million in heavily restricted, low liquidity assets. His financial system operates like a massive concrete dam holding back a deep reservoir of digital wealth, but the structure is relentlessly bleeding water through microscopic sovereign tax fissures. He is forced to constantly pump new water into the reservoir from external sources just to maintain the baseline structural integrity. The timeless thesis is this: under a sovereign wealth tax regime, owning massive paper assets without corresponding liquid cash flow is a mechanical death sentence. The empire builder becomes the empire's most exhausted employee. The wealth engine can never safely be powered down. To the members of the Capital Logic Network who support our channel and make this possible, thank you for everything.